Now, the next pitfall is emotional decision making. I love this quote from Mark Manson. Decision making based on emotional intuition without the age of reason to keep it in line pretty much always sucks. And often I find people very emotional about buying a property. They get their heart on their sleeve and they go, this is the one, I have to have it. And it's partly FOMO, it's partly they're sick of looking, they've been on realestate.com for ages, and then they just go, God, just help me get something, and this is the one. But remember, when you're buying a property, there's always another one around the corner. And more often than not, when people have missed out on their supposed favourite property, they end up finding a better one, no problem. So I have found that time and time again, every time when someone says to me, oh, I've missed out on my favourite property because I didn't, blah, 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 and we didn't have a pre-approval and whatever. And then the better one comes up and they go, well, imagine we would have got that much better. So falling in love with a property without really doing your due diligence is a problem. Rushing the purchase due to FOMO, or people just get sick of offering, and that they've only offered on one or two properties, but they find the whole emotional roller coaster of that just too stressful. And I can understand that, but really you've got to consider it a game and how you play the game. It's a really good idea because often you can make 100 offers before you will get the right one and the right property cheap enough. And that's the game you should be playing. You're thinking, well, if I'm going to buy a property that really works on the numbers and is a good investment, I want to be able to say that was definitely as cheap as I could get it and it's good for all the right reasons. And overlooking property flaws. People will often say, oh, well, I knew it had this, this and this, but I decided to go with it anyway. Please be aware of that. You just got to know yourself when you're looking and making these decisions. It can be really tricky. Signing too quickly without any safety net. So I've had agents asking people to waive their cooling off rights. There's a lot of that going on at the moment. And saying you've just got to purchase it and pay your deposit and then we'll send you a contract. We've actually had that in the last 24 hours. And luckily our conveyancer rushed in and said, no, don't sign it, it's dodgy as. And the vendor had wanted them, if they were a day late in settling, they'd have to pay his land tax for all his investment properties across Australia, which could have been like 100 grand. Like, you got to be kidding, that's an unknown figure. And if you had signed that contract, that's what they would have been stuck with. So you've got to be careful and make sure you still do a proper due diligence. Get your conveyancer to check those contracts carefully. I've had a client have in a contract, she was buying a unit in a block of apartments and the vendor had said, because he owned another property in that block, and he'd said in his contract to her that she could not make any vote against anything he wanted in the body corporate. Like, what the hell? I'm sure that clause was illegal, but he'd put it in the contract, which is as dodgy as. So it made you think, what on earth was he up to? It sounded really, really strange. And often if people have pushed too hard and too fast, there'll be a reason that there's something wrong with the property. So you need to be very aware that there's nothing wrong before you get stuck with something like that. Don't get rushed in. Non-emotional decision making. You need to set your criteria before. And one of the ways is actually to write down what you're actually thinking in making your decision. People, you forget. You think you won't, but you do. Oh, well, I certainly do. I mean, I can't remember why I booked a certain flight at a certain time, but at the time it was really sensible. I was okay to get up at 6 a.m. and then on the day I'm thinking, what the hell was I thinking? And it's a really good idea to start writing down why you made that decision at the time, because then you can refer back to it. And there's a great app called My Mind. You can file anything in there and it keeps it for you, and it's very easy to find. I find the notes on the App Store a bit more difficult to sort through, whereas My Mind's very simple. So I highly recommend that. It's a great tool. So set a clear investment criteria. How long are you going to hold it is the main thing. Are you searching for a quick flip, or are you actually searching for a longer term investment? Then if you've made that decision, you stick with it. The key reason why people fail at property investment is because they sell too early. Now, there was a study done by the 𝗬𝗓, the Australian Housing and Urban Research Institute, and they said this is the problem for most property investors. They just sell out too quick, and that causes them all the problems. So if you can just hang on, I've had 2 super successes this year. I've had clients who've had property and they built their portfolios over the preceding 10 years. And at different times when that's been going on, I said, oh gosh, with lots of kids and high school and things going on, really, do you really want to hang on to all these properties, or do you, it's getting a push? No, he said, we'll hang on. And sure enough, now we've come around again to refinance them and get them a more suitable rate once again. They've now got properties with no debt at all, several of them, and most of the debt's under 60% loan to value ratio. So they're going to have 5 more years of that and they're paying themselves off and nothing to worry about. Same with the others. You're getting houses that are unencumbered because if you hold them long enough, and the big problem is people not holding them long enough. So you've got to think that in mind. And also, when you're comparing the facts and figures in the same area, go on the size of the land or the footprint of the property, not just the price on beds and bath. People say, oh, but I've got a 2-bedroom, 2-bathroom here and it's worth this much. And that one's worth this much. But when you look at it, one's got double the land, or an extra garage, or double brick, or granny flat, or whatever. They're not comparing the same thing, nor are they comparing the quality. And often people, when they're using their own property as an example, the quality, you always think it is a lot better than what it is. As if anyone's sold property, you always get softened up by the agents. You have these grand visions about what you might get, and then you get sunk down. And focus on rental yield and capital growth potential. You can't just have rental yield. Cash flow positive properties are great, but it's no good if they don't grow. So you still need a property to grow. And it's no good just relying on rent return. Sure, we want great rent return, but we really, really need a property to grow to make the most difference in a portfolio. So concentrate on capital growth potential and what you can afford in that areas. That's more important to get the maximum benefit from your portfolio. Next, poor due diligence. Diligence is the mother of good fortune. There you go. Now, I've had people skipping building and pest inspections, and that's always a mistake. Not checking strata reports, insufficient legal checks, council zoning, and no build areas. As an example, a client of mine bought a unit down in Geelong on a 2 on a block, I think it was, and that we were buying the back one. And he said, oh, it's new, it shouldn't need a building and pest. I said, no, get one just in case so we can see what's going on with it. Sure enough, lucky we did, because although it was a new build, even though it had been signed off by the surveyor, it had not had the insulation put in the roof, and they'd signed it off regardless. So we contacted the builder and said, well, what you've created and what your surveyor's done is really a fraud. And they'd given them the 5-star energy rating when this was completely a lie. And the guy in front had settled without a building inspection, and he was very lucky that we did it, so he got his fixed by the builder, due to us going to the trouble and making sure it was done properly. Not checking strata reports. People have had, particularly in some of the suburbs in Melbourne, I've had a client with the house in a big high-rise in Richmond, and all the balconies were a problem. And each balcony was going to cost the owner $10,000 or more to get fixed. And if you didn't check the strata reports, people buying these properties would end up with a huge amount of debt. And also for those owners who could, and they might think, oh, well, I'm getting a cheap property. And that has happened. Another friend had a property in a body corporate in Ormond in Victoria. And there was leakage all through the building, and her apartment got riddled with mould. And the body corporate refused to fix it. And if you had read the minutes of this building, you would never touch it with a 10-foot pole. And the people who'd caused all the trouble and wouldn't refix things left the building because they knew it was a disaster, and they sold out without telling anyone. And those who bought it ended up with complete lemons and huge costs associated with repairing what's going on. And that's why often when buying an apartment, the conveyancing is often more expensive. People don't realise, they go, oh, it's a flat, why is it more expensive? Because they have to do more checks for you. And they should be doing a check as soon as you purchased and just before settlement, in case there's been a meeting in between those two, and then there's now some special levy for saying, oh, you're going to have to pay a special levy of $10,000 to fix whatever. So you want to know about that before you actually get in. And those are the reasons why you need those legal checks done. Another client sold the back half of their block in the Dandenongs, and the people who bought it did not do any council checks and then could not build on it. So they'd paid for the land, but they couldn't build on it, couldn't do anything with it. So that's a scary thought, isn't it? Good for my clients, really good. They sold the back and still had the land to look at. But anyway, I love this one. I'll describe the house with words like yummy and tasteful, instead of mentioning the termites specifically. And I had other clients buying a place in Albury, and the people had put down a new floating floor, and they go, oh, Louise, it's so gorgeous, and blah, blah, blah. I said, no, get a building and pest, always. And sure enough, under the floating floor was all this rotten, termite-ridden planks, and they'd just gone in and covered it, and those who didn't do an inspection would have ended up with that nasty surprise later on. So we found out. So what's the difference between using a conveyancer and a solicitor? So while most conveyancers, and particularly the ones we recommend, are terrific, solicitors are actually backed by the Law Institute in their state. So there's no chance of them running away with your deposit or redirecting the funds for your purchase to the wrong way and you not having any legal cover. Whereas conveyancers don't necessarily have that same protection. And conveyancers can redirect, as was a case not so long ago in Geelong. Some rogue conveyancer started taking lots of people's money and then shot through. And you don't want to be that person whose deposit or house funds were cashed in and taken away. So just a word to the wise, if you're going with a conveyancer, make sure they're well established and they know what they're doing, or use a solicitor and you know you have legal protection in the background. I'm sure people, you're aware of that. Are all conveyancers lawyers? No, they're not. Most conveyancing firms now are run by people who are just qualified in conveyancing, and they might refer your matter to a solicitor, but most of them will do the work themselves. So yes, that's a bit tricky, really. Tax and legal oversight. Ignorance of the law excuses no one from practicing it, and that's the problem. Not understanding the tax implications of your actions, wrong ownership structure, not suitable for lending, and missing out on deductions. So these come up often with people who haven't done their due diligence. And this is what happens. People start at realestate.com or Domain, and they go looking for houses before they've had all the conversation with their accountant or solicitor, all the people who they should be talking to first. And then they've bought the place, signed a contract, and then come back to us when the loan's approved and say, oh, now we need to change the ownership structure to a company or a trust, or no, it's not going to be in his name, it's only going to be in her name. It's often too late. And if you want to settle on time, we cannot change it. And in some states, like in Victoria, you can put and or nominee, and that can change who purchases it. But in Queensland, people who have changed the name of who was purchasing were made to pay stamp duty twice, because the government there considered that a sale. So if a husband said, oh, I'm going to buy it, but then, oh, now I want to put it in my wife's name, that was considered a sale. So he paid stamp duty on his purchase, he gave it to her immediately, and she paid stamp duty as well. So be very wary where you're doing this, in which state. So wrong ownership structure, it can be, people go, oh, at the last minute, can I just change it to 60% to me and 40% to him? No, you need to have those discussions well before, so that we're very clear about who percentage of ownership is before we go and apply at the bank, because the bank can come back and say, no, we're not lending. And the other thing to watch out for is if people are from overseas and purchasing, sometimes, even though they're first-time buyers, they might not have PR or permanent residency. The state revenue officers will charge them stamp duty, but the other party will get it exempt. So you need to watch for that and make sure that one of you're both exempt, and get that clarified up front, because we had a recent settlement held up because the conveyancer had not conveyed the PR status for the clients to the state revenue, and they'd come back and said, give us another 30 grand of stamp duty, which the clients did not have. And they hadn't sorted that out until the very last minute, which nearly derailed the entire settlement. So that can cause you a world of pain. And on that, don't make settlement on the same day as, don't make moving in on the same day as settlement. Always give it a day, at least, preferably two, so that you can actually organise it easier. It can be a real problem trying to get settlement, unless it's a concurrent settlement where you have to go from one to the other, and then they've both got to proceed. It can be a real problem and you can get stuck out and missing out on tax deductions because you've done it the wrong way. So understanding the negative gearing implications, plan your ownership structure prior to buying, not during the purchase, and keep detailed records of why you made your decisions, and consult with your tax accountant, legal rep and financial planner, obviously. I often recommend have a look on the Band Tax website. They have some really good information there on accounting and items for property investors that is very useful. So I highly recommend. They're accountants, and Julia just does research nationally for all of their group. So property management issues is another thing. I love this. I love Simon Sinek. He's got some really sensible thing to do. So poor tenant selection. And the reason why I put FYI single mother's rock is because more often than not, people say to me, oh, I wouldn't want to get a single mother as my tenant. And I have found single mothers have been the best of my tenants because they don't want to move too often. They want to have a good place for their children, and they generally have stable income and it's reliable. They know what they're doing and they want to be near a school and stay there for years. So I would highly recommend that you stick with them. But often people have these preconceived ideas about what is a good tenant and what isn't. And my son has two boys from university in his place, but they're both studying physics, and he met them and they were so nerdy, he thought there's no chance these two are getting up to trouble, and he was right. They are very nerdy and so they're not doing anything. Inadequate insurance can be a problem, and do-it-yourself management. Property management is not something you can keep up with unless it's your job. It's same as broking. Property management, the laws change all the time. The government's always interfering in this area, trying to help tenants. And as a landlord, if you're not abreast of all the issues that can come up, it can cause you real trouble. So, property managing like a pro. Use a professional, but I micromanage them. That's the key thing I want to tell you to do. You want to manage like a queen, but micromanage your property managers. Understand the tenancy laws. You do need to know you're not allowed to go visit your property without giving 7 days notice. People sometimes will have the landlords rushing around and poking their nose in or taking out the bin or checking on the garden. That's not appropriate for a tenant either. Set a maintenance budget. Often people think they just hear nothing about the property and they never will fix anything, and that is a big mistake. All houses need maintenance and continuing to do it, so make sure you do. And I think it's a good idea to do inspections. I try not to meet the tenant, but sometimes it's worth it just to go in and see what's happening so you can find out and make sure things are running like you expect them to be. And finally, pitfall number 7 is cash flow management. Making more money will not solve your problems if cash flow management is your problem. And so many times I meet people who do not know if they can save money. And if you can't save, then that is the problem. We need to be able to spend less than we earn. So often people overestimate the rental income and underestimate the outgoing expenses. And they don't keep a capacity for vacancy. They go, oh, once it's rented, then I'm right. But generally you could allow up to 4 weeks a year, and then you need to have that in reserve for you. And not knowing your personal budget. This is the key. And most people don't. And how do I know? Because I look at people's accounts all the time. We have to, when you're applying for a loan, we review your accounts for the last 3 months. So we're seeing what you're spending it on. Is there gambling happening? Are there things that shouldn't be spent? Are there any direct debits that we should know about? So they're looking at 3 months of your account spending, and you should be looking at them too. So before you apply, go and have a good peruse of your savings accounts and go, oh, would I want someone else looking at all of that out of my accounts? And they look at every account you have. So be careful. Just worth knowing. So to be a cash flow king, know your own spending, regularly increase your rent. People do not do this. And the tenants are not your children. People go, oh, I've got a good tenant, I don't want to put the rent up. What a load of crock. And then the problem is, if you do not raise your rents consistently, when you go to next borrow, the bank goes, oh, well, you're only earning that as a rental, even though that area should be a lot higher, then you can't borrow as much because of that. And it can be very hard to catch up. So you need to increase every year regardless, even $5, but something. You need to increase your rents all the time, or you get too far behind the market. And if that tenant's there for a few years, you are way out of the market. And that can be a big problem when you next go to borrow. And maintaining an emergency fund. We want you to have a look at that. Always keeping that buffer account available. And as I said, vacancy period of 4 weeks a year, just to keep in mind those things that are important. So the things we've covered are poor money planning, location selection errors, emotional decision-making, people loving property and loving it too much, poor due diligence, not actually having a proper investing mindset when you're going for it, tax and legal oversights, property management issues, and poor cash flow management. And key things. So I want you to do proper research, get professional advice before you act, and plan for the long term. This is not a short-term game. This is very serious. And to make real money in property, they make it by holding on and doing it longer. Next step. So if you want help assessing your financial position, please feel free to reach out. Meet with the key professionals. And if you have an accountant that you don't feel comfortable talking about this, maybe they don't invest in property, or it's all just an exercise to them, but they don't ever understand having their own money on the line. You want to speak to someone who does do this. And create your own investment criteria so you know why you made these decisions, and then you start to search. But do all that first. Now, does anyone have any questions? Feel free to ask. Let me see. Oh, so how to hire a property manager? Good question. One of the things I would advise people do is to ring up and pretend they were the actual tenant trying to rent a place and see how they got treated. And that can be really interesting about how people are treated and what the property manager did, because often property managers will treat tenants like they're not worth anything, and that can be a problem. And you want someone who treats everyone the same and is decent and worthwhile. So I would say to people, definitely check out the property managers, and I would ring 3 in an area and see how they relate to you. It can be, the other thing you've got to be wary of is that a lot of them are younger and more likely to be sympathetic to the tenant than to you. So you want someone who understands your role in this, that you're not some rich capitalist, that you're actually just trying to make a buck and get by. And that can be, so you see what understanding they have. If you want further help, feel free to book an appointment, visit our website, or call me. No problem. So thank you for coming along and listening in. I really appreciate you being here. And if you have any questions, I hope you found this of some use to you. See you then. Take care. Have a great evening, everyone.